Hello everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 16. In this lecture, we will discuss the ICAI question answers, practical examples and illustrations of ICAI module chapter number 3, that is Ind AS 115. We will simply learn the practical application of the provisions that were provided in Ind AS 115. Please watch this only after understanding the concepts that we have discussed earlier related to Ind AS 115. Okay, are you ready? For this, you will be requiring the ICAI module, the updated one. If not available, no worries, you can get it from ICAI portal, or else it is also available on our app. Let's begin with our question answer round. Let's head towards page number 10, 3.10. Illustration number 1. New Way Limited decides to enter a new market that is currently experiencing economic difficulty and expects that in future economy will improve. Okay, New Way enters into an arrangement with a customer in the new region for networking products for promised consideration of 12,50,000. Okay, there is a New Way company, okay, which has decided to head towards a new region, and it is charging a promised consideration of 12,50,000. At contract inception, that is at the beginning of the contract. Inception means the beginning of the contract. At the point of beginning of the contract, inception, New Way expects that it may not be able to collect the full amount from the customer. Determine how New Way will recognize this transaction. Now, as you know that there were 5 important points given to recognize the revenue. Okay, there was one particular step which said that there should be high probability, okay, that the amount will be collected. Okay, there is high probability, high chances that the amount, the promised consideration will be received. Since here there is lesser chances that the company will not be able to collect the amount, okay, the full amount, therefore you cannot record the revenue. See, assuming that the contract meets the other criteria covered within the scope of the model, in Ind AS 115, New Way needs to assess whether the collectability is probable or not. Okay, if it is highly possible that there will be lesser chances of full recovery, there are high chances of bad debts, then they will not be able to recognize in the balance sheet. In making this assessment, New Way considers whether the customer has the ability and intent to pay the estimated transaction. New Way Limited should evaluate whether its customer has the ability or not, intention or not, which may be an amount less than the contract price. Okay, are you clear with this concept, that it should be highly probable that the full amount will be collected? If not, then there are very much requirement that the company, the entity should reassess, evaluate the customer ability to pay such amount. If yes, then you will record it. If no, then you will not record it in the books of accounts. Okay, head towards next one. Illustration number 2, page number 11. A gymnasium enters into a contract with a new member to provide access to his gym for a 12-month period. Okay, there is annual memberships are given. Okay, so 12-month period has been entered in for a new member at rupees 4,500 per month. The member can cancel his or her membership without penalty after 3 months. Specify the contract term. So, as you know, whenever there is a fixed term up to which there cannot be any cancellation, up to that a contract is one. Okay, other than that the contract is separately recognized. Okay, so this one particular 3-month period for which the contract is valid till the time when it cannot be cancelled by both the parties. Okay, since there is no without any penalty, then this 3 month is the contract term of such contract with that particular new member, or you can say new customer for that gym. See, the enforceable rights and obligations of this contract are only for the 3 months. As you know, we have seen in the notes, for the fixed term, for the particular term up to which there is no cancellation possible, and therefore the contract term is 3 months. Here, this simple example just tells you how the contract term is decided. Okay, when it should be recorded. These are simply different practical examples that you can face while preparing your financial statements or while answering your question answers in the exam or in your practice papers. Okay. Reading these illustrations is very important. Contractor P enters into a manufacturing contract to produce 100 specialized CCTV cameras. Okay, there is a contract that it will be manufacturing what 100 specialized CCTV cameras for customer Q for a fixed price of rupees 1000 per sensor. Okay, rupees 1000 per sensor. Customer Q can cancel the contract without a penalty after receiving 10 TVs. Okay, so the contract is for that minimum amount for which the contract cannot be cancelled. As we consider the previous illustration number 2, there was a minimum period for which contract cannot be cancelled, that was 3 months. So the contract period was 3 months. Here the minimum amount till which the contract cannot be cancelled is 10 CCTVs. Okay, so contract will be of 10 TVs only. Okay, specify the contract units. See, read this answer, you will get a better understanding. P is the seller. Okay, P determines that because there is no substantive compensation amount available by Q on termination of the contract, that is no termination penalty, in the contract, it is akin to a contract, that is very important to the contract, to produce 10 CCTV cameras that gives customer Q an option to purchase an additional 90 CCTV cameras. Hence, contract is only for the 10 units. Okay. Now, if we talk about the substantial compensation, what is this? We have discussed this in the notes part. Okay, in this previous lectures related to Ind AS 115. What is this? If, for example, on the initial one, on the inception of the contract, it is dealt that, for example, even if you purchase, okay, this is another example just to give you an understanding about the substantive compensation. So, for example, if you have entered into a contract of 100 CCTV, okay, and you will be delivering that, and under this deal, what a clause has been put in that, whether you purchase this 100 CCTV or not, okay, even if you cancel it on the receipt of 80 TVs, okay, then also you will have to pay for full 100 CCTVs, okay, there is a clause, for example. Then in such case, okay, this amount, the whole amount, the penalty amount will be recorded at the inception itself, because this is substantive compensation. This is being received on, this is being very much confirmed that you will be receiving such amount, because either that particular customer receives such 100 CCTV or denies to receive the remaining 20 TVs, okay, CCTVs. On the either cases, they will have to pay, that particular customer will have to pay the full amount of 100 CCTVs as per the contract. Okay, so this is substantive compensation. Since under this contract, there is only 10 CCTVs minimum criteria has been put in, and there is no compulsion that they will have to buy the other remaining 90 CCTVs, and other than that, there is no compensation laid down that if you cancel the contract, you will have to pay such and such penalty or the full amount. Therefore, it is written that because there is no substantive compensation, okay, there is no such criterion clause, therefore, we will not be recording at the inception itself. We will only be recording for the 10 units. The contract is only for the 10 initial units. Okay. In case of any doubt, please let me know. Okay, what you can do is either you can comment in the description box, okay, comment in the comment section, or you can download the app and chat with me. Now, next illustration number 4, page number 13. Manufacturer of airplane for the Air Force negotiates a contract to design and manufacture new fighter planes for a Kashmir air base. At the same meeting, the manufacturer enters into a separate contract to supply parts for existing planes to other bases. Since there is separate contract, manufacturing and designing of new airplanes is separate, and supplying parts for existing one is separate. Then would these contracts be combined? See, contracts were negotiated at the same time, but they appear to have separate commercial objectives. there is separate commercial objectives. What does this mean? This means that the risk reward is separate. They are negotiated not as a single package. Instead, they are negotiated as separately. The risk, reward, benefits, whatever the performance obligation are separate. Okay, that's why there is commercial or separate commercial objective. Manufacturing and supply contracts are not dependent. They are independent of each other. They are not dependent on one another. It is not like when you will be supplying the parts for the existing planes, then only you will be having a chance to deliver to design and manufacture the new airplanes. Okay, there is no dependency on either of the contract. They are negotiated separately on one another, and the planes and the parts are not a single performance obligation. Okay, both the performance obligations are separate because the promised transfer of goods and services is separate for both the contracts. Okay, in one contract you have to design and manufacture the new planes. In the other contract there is separate performance obligation. The promised goods and services are separate because you have to supply the particular parts for the existing planes. Okay, so there is separate performance obligation. Therefore the contract should not be combined. Next, illustration number 5. Software company S enters into a contract to license its customer relationship management software to customer B. 3 days later, in a separate contract, S is what? The software company. S agrees to provide consulting services to significantly customize, very important point. Okay, any services which are along with the main product. Okay, and if it is significantly impacting the product, then it is considered as one contract. Okay, when the services are can be taken from any other vendor, or is a service which does not significantly or does not impact the existing product or the main product vastly. Okay, if the impact is high, the impact is significant, then it is considered as one product. Okay, if the impact is very less, negligible, then it can be considered as separate. So here what is the case? That S company that is providing the consultancy is very much significant. Okay, significantly customize the licensed software to the function in B's IT environment. B is unable to use the software until the customization services are complete. It is creating such a vast impact that the user is unable to use that software without such consulting customization. Okay, so it is creating a very much impact, therefore it will be considered as one particular contract. Okay, one particular performance obligation. See, S determines that the two contracts should be combined because they were entered into at nearly the same time with the same customer. Okay, it appears that it should be considered as one contract. Okay, and the goods and services in the contract are single performance obligation because it is creating significant impact. Next, illustration number 6. Please read it carefully. Okay, manufacturer M enters into a contract to manufacture and sell a cyber security system to government related entity P. 1 week later, in a separate contract, M enters into a contract to sell the same system to government related entity Q. Okay, so there is M manufacturer that is supplying, okay, that is supplying cyber security system. It is supplied to P, it is supplying to Q as well, and both of these entities are government related. Both entities are controlled by the same government. Okay, this means the controller of P and Q is the same government. During the negotiation, M agrees to sell the systems at a deep discount if both P and Q purchases the security system. So is it dependent? Are both the contracts entered separately, but is there high dependence that if P purchases, then only Q will be getting the discounts? Okay, is it highly interrelated, highly dependent? Okay, therefore it should be considered not separately, it should be considered as one. Should these contracts be combined or separately accounted? See, this is a simple question. If you are able to identify the performance obligations, if you are able to identify is there is any dependence or not, is the impact is significant or not, okay, then you will easily be in a position to answer this question. Okay, read the solution and let me know. I'll read it for you along with. M concludes that said two contracts should be combined because I said that it is so much interrelated, so much interdependent, therefore it should be what? It should be considered as one, combined. P is a related party to Q. Okay, it is a related party. The contracts were entered into a nearly the same time and the contracts were negotiated as a single commercial package, which is clearly evident from the fact that discount is being offered if both the parties purchases the security system, thereby also making the consideration is one contract dependent on the other contract. Okay, it is highly dependent and therefore it should be combined. Next, illustration number 7, page number 16, 3.16. Okay, illustration number 7, an entity promises to sell 120 products to a customer for 1,20,000, 1,000 per product. Okay, 120 products are to be sold and at the rate rupees 1,000 per product. The products are transferred to the customer over a 6-month period. Okay, in the following upcoming 6 months they will be delivered. The entity transfers control of each product at point in time. After the entity has transferred control of 60 products, once the entity has transferred the control of first 60 products to the customer, the contract is modified to require the delivery of additional 30 products. This means 120 was initially ordered. Okay, 120 was initially ordered plus 30. This means 150 needs to be ordered. Okay, and 60 have already been delivered. There was a contract of 120 units. 60 have already been delivered and now it is asking for additional 30. A total of the 150 identical products to the customer at a price of 950. Earlier it was 1,000 and now it is 150. Okay, so 150 units need to be transferred. Out of this, 120 will be transferred at the rate 1,000 and the remaining 30 will be transferred at the rate 950 rupees. Okay, where is it? 950 per, which is the standalone price. And importantly, as we know, we have seen the chart as well, that we need to question 2-3 points. Okay, if we satisfy, then we record it as separate, otherwise it is recorded as modification in the particular contract itself. Okay, so as you know, the amount is separate, the goods are distinct. Why distinct? Because each product can be used on its own. Okay, it has a capacity that it can be used on its own or by using the available resources. Okay, so it is not dependent, the particular one, each unit is not dependent on any other. Okay, so these additional 30s are also distinct. The next price that is being discussed or that is being agreed, that is rupees 950, is standalone price. Therefore, okay, selling price for such additional products at the time of placing this additional order. The additional 30 products were not included in the initial contract. It is assumed that the additional products are contracted for a price that reflects standalone price, selling price. Determine the accounting for the modified contract. Okay, see. So it should be recorded as 2,500. How come? 950 into 30 units. The price for the additional product reflects standalone price and the contract modification, and the additional products are distinct. Okay, there are two important points: standalone and distinct goods and services. Accordingly, it should be a new and separate contract. It should be recorded as new and separate contract. If the goods were dependent, were not distinct, were not having a capacity to be used on their own, or on the other hand, the amount that is being charged was not standalone price. If either of these two cases, it should be recorded as same contract. But here there is separate standalone price, okay, and other than that the goods are distinct. Therefore, it should be considered as separate and new contract. Such modification should be recorded as separate and new contract. Next, illustration number 8. On 1st April 2001, the KLC Limited enters into a contract with Mr. K to provide a machine of 2.5 million. Okay, on 1st April, KLC enters into a contract with Mr. K to provide a machine for 2.5 million. 1 year maintenance services. Okay, so there are two separate things. There are two separate performance obligations. Why? In respect of one contract, you have to deliver a machine. In respect of another, you are promising to deliver a maintenance service. Okay, 1 year service. It is 1 year service for rupees 55,000 per month. So it should be a separate contract. 2.5 million machine should be a separate contract, and 1 year of maintenance service should be a separate contract. On 1st October, that is after April, that is after 6 months. Okay, after 6 months, the KLC Limited and Mr. K agree to modify the contract to reduce the amount of service from 55 to 45. Now, for first 6 months, it was at the rate 55,000 per month. Now, after modification, see, after modification, what has happened to next 6 months, the remaining 6 months. Why remaining 6 months? Because the contract is for 1 year. It is now recorded at 45,000 per month. Okay. Determine the effect of change in the contract. Now, the new liability will be created at the rate 45,000 into 6 months. Okay. The next 6 months of the service are distinct. Why distinct? Because it can be separately consumed from the services provided for the first 6 months before modification in the contract. Therefore, KLC will account for the contract modification as if it were a termination of the existing contract and the creation of a new contract. Okay, as if for earlier it was of 1 year. Now, on completion of 6 months, it will be considered as if it has been the existing contract has been stopped, has been cancelled, and now a new contract has been created at a new standalone price, that is 45,000. Okay, thus consideration promised, okay, the consideration allocated to remaining performance should be 2,70,000. How come? 45,000 into 6 months. The consideration promised by the customer, including amounts already received from the customer that was included in the estimated of the transaction price, had not yet been recognized as revenue, because the next 6 months that were upcoming were not recorded still as a revenue. Only for the first 6 months they were recorded as the revenue. Okay, because at the end of every month, the revenue is being recognized in the books of accounts. It is not like in the advance for the whole 12 months you have recorded the revenue. Okay, the line is same, that you have not already recorded. Okay, you have not already received, neither you have already recorded. The 6 months were not yet recorded, and that's why you do not need to cancel them or reverse them. The consideration promised as a part of the contract modification is 2,70,000. Next, illustration number 9. Grow Limited enters into an arrangement with a customer for infrastructure outsourcing deal. Based on its experience, Growth Limited determines that customizing the infrastructure will take approximately 200 hours in total to complete the project and charges rupees 150. Okay, so I have discussed the same question in the notes part. Okay, see, it is being repeated again, that initially it was 200 hours at the rate rupees 150 per hour. Okay, per hour. Now, after incurring 100 hours, after completion of the first 100 hours, Growth Limited and the customer agree to change an aspect of the project and increase the estimated labor hour by 50 hours. Initially it was 200, now 50 hours has been added at the rate rupees 100 per hour. Okay, so initially it was 200 hours, now it is addition of 50 hours. So it will be a contract of 250 hours now. So how should it be recorded? So as you know that after incurring 100 hours, first 100 hours have already been completed. First 100 hours have already been incurred, have already been completed, and have already been recorded. okay, at a previous rate, that is 150. So first 100 hours should be recorded at 150 rupees per hour, okay, and the remaining next 150 hours, now you need to see that how it should be recorded. So for this, there will be 100 hours, okay, this 100 hours should be recorded at a new rate, at the rate new rate. How to record that new rate? After calculating this, you will take a weighted average, and as per that amount, you will be multiplying this particular 150 hours, okay. Next, see the solution, you will come to know. First 200 hours were decided that it will pay 150 rupees per hour, okay, that is 30,000, and addition of 50 hours has been done, okay. This means that total 35,000. Now as you divide 35,000 divided by 250 hours, it is equal to 140. Now the new hours, okay, the upcoming hours will be recorded at rupees 140. Initial first 100 hours were recorded at the previous rate. Now as per the modification, a new rate will be calculated, that is average, weighted average, okay. So revenue to be recognized, that is upcoming hours, okay, and already booked, that is already incurred hours. Are you getting a good picture? Are you able to understand this? Adjustment in the revenue will be 1000 negative, okay. Next, what is explicit promise of service and what is implicit promise of service? There are two topics I think we have discussed in the notes as well. To make it a little clear, let me discuss this once more time. That whenever you are doing a contract and you are specifically, explicitly, or you can say separately negotiating the terms, okay, are laying down the terms and conditions, this is known as explicit. Whereas implicit contract is where the terms are not being negotiated, it is already known to both the parties, okay. It is written in their contracts, or you can say it is already as per their past business practices, it is known to the customer as well as to the seller that this particular clauses will be applied, this particular services will be held along, and no need of further discussion. So if you have discussed those extra policies and whatever the clauses are there, if you have discussed, then it is explicit services. If you have not discussed it while negotiating, then this is known as implicit, that is already implied due to past services experience, okay. So these are two types of services. Now there is two-step model to identify, as you know, okay, which good or service are distinct. As you know, how to identify two goods, whether the good is or service is distinct or not. Two step. First, is it capable of being distinct, okay, is it in a position that it can be consumed on its own, okay, can it be consumed on its own or using the available resources, okay. This is a very good definition, okay. This is a definition which is very important both for professional and for a student, okay. You need to identify that particular good or service can be used on its own, has the capacity to use it on its own, or it can be used from the available resources. If yes, then they are distinct. Other than that, they are not distinct. If distinct, then they can be recorded as separate performance obligations. If not, then they need to be combined with another or existing one. Focus on whether the goods and services are distinct on the contract. The goods and services is not integrated, okay, this is also important. It should not be integrated, it should not be highly dependent, okay, highly interrelated. If highly dependent, highly interrelated, highly making a significant impact on the existing one, existing main product, then they will be treated as one particular contract, okay. Significant modifying, this is very important. Make sure you understand both of these points. Next, example number 1 is given, page number 22. An entity promises to provide a customer with software that it will significantly customize to make the software function with the customer's existing infrastructure. Okay, based on its facts and circumstances, the entity determines that it is providing the customer with a full integrated system. okay, and that the customization service requires it to significantly modify the software. High integration, significant modification, this means that it should be recorded as one. The products are not distinct, they are highly interrelated, highly dependent, highly impacts the other product, okay. So therefore it should not be recorded, it should not be separated, it should not be considered as distinct software in such a way that the risk of providing it and the customization service are inseparable. That is, the software and the customization service are not separately identifiable, therefore they are not distinct. Are you clear with this fact? Okay, we will study only 13 illustrations in this particular lecture, then we will head towards the next lecture. Okay, we will take a break and record another lecture. Illustration number 10. Okay, only 13 lectures, please go and watch it till end, so that you are in a position to have a clear understanding of the Ind AS 115. It is thoroughly asked in interviews as well. A construction service company enters into a contract with the customer to build a water purification plant. The company is responsible for all the aspects of the plant, including overall project, management, engineering, design, site preparation, physical construction of the plant, procurement of pumps and equipments for measuring and testing flows, volumes and water quality, and the integration of all the components. So as a whole, you are given a project. Now you have to take care, you are an entity and you have to make sure that all the things are being delivered, all the things that are required is done by your entity. Okay, so but at the end what you are doing is, you are not supplying a particular design, you are not supplying your engineering services separately, you are not supplying a particular testing or measuring services separately. Instead what you are doing is, you are preparing a whole project, and your performance obligation is to prepare and finally submit or finally hand over, or you can say transfer, this particular whole project as one to the customer. Okay, the contract is to build up the whole plant, whole project. Okay, it is not for any separate things, okay, separate services and separate goods. Therefore this particular goods and services that you are being transferring, okay, should be considered as one particular package. Okay, it should not be separated, as there is one performance obligation. The performance obligation is only one, that is, the responsibility of you is only to transfer the build up whole plant. Other than that, there is no other thing. So it is considered as a whole, the whole project is considered as one performance obligation. Determine whether the company has single or multiple performance obligations. Okay, read this answer. We have discussed this in the notes also. Okay, these are repetitive question answers. Okay, an entity provides broadband services to its customer along with voice call service. Customer buys modem from the entity. However, customer can also get the connection from entity and modem from any other vendor. So there is no compulsion that you need to buy the modem and the services from one particular entity. Okay, there is a free market. Okay, you can buy any particular one thing from this company and another from any other company, any other vendor. So these can be separated, these are distinct. Why distinct? Because can be used on their own, can be purchased from separate, can be purchased separately. There is no particular obligation, there is no dependence, no interrelation, highly interrelation. Okay, the installation activity requires limited effort. It is so limited effort that it does not significantly impacts the main product. Okay, the installation activities require limited efforts and the cost involved is almost insignificant, does not impact the main product vastly. Okay, it has various plans where it provides either broadband service or voice call service or both. Are the performance obligation under the contract distinct? Yes, it is distinct. Okay, the broadband service is separate, the voice call service is separate, and the modem purchase is also separate because it can be purchased from any other vendor as well. Okay, are you clear? So therefore these are distinct. These are distinct. For answering, or you are, if you are preparing for ICA exam, you need to learn that particular definition of distinct goods and service. It should, okay, and then write it down. See the answer. Broadband, based on the evaluation, we can say that 3 separate performance obligations: broadband, voice call and modem. 3 of them are 3 separate performance obligations. If you are reading for exam purpose, please make sure you go through the whole answer and observe the writing pattern very carefully, because for scoring high you really need to replicate these answers in your answer papers. Okay. Illustration number 12. An entity enters into a contract to build a power plant for a customer. The entity will be responsible for overall management of the project, including services to be provided like engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment and finishing. Determine how many performance obligations does the entity have. You will be answering this question in the comment section. Okay. Answer number 12. You are required to build up a power plant for a customer. Please answer, okay, in the comment section. I am not discussing the answer because I don't know the answer. No, I don't know the answer. You will be telling me the answer. Example number 2. A vendor enters into a 5-year contract with a customer to provide continuous access, okay, continuous goods and service, continuous access to its system and to process all transactions on behalf of the customer. The customer is obligated to use the vendor system. Now there is no separately available that you can purchase it from any other company and you can get the services from there. Okay, it is compulsion that the customer is obligated to use the vendor system, but the ultimate quantity of transaction is unknown. It is unknown as for example the electricity bill. Okay, so you have to buy the particular setup and the connection from that particular entity, and the bill also comes from that particular entity. Okay, the services are also supplied from that particular entity, but the final consumption is not known, because only at the end of the month you come to know that in this particular month what is the consumption of the particular power. Okay, so the ultimate quantity of transaction is unknown. Okay, are you able to connect? Think it as an electricity supply. Okay, so the ultimate quantity is not known in the initial stages. The vendor concludes that the customer simultaneously receives and consumes the benefits as it performs. Okay, simultaneous, there is receipt and consumption. As you know, we have discussed a separate concept of point in time or over the period of time. Okay, if the vendor concludes that the nature of its promise is to provide continuous access to its system rather than process a particular quantity of its transaction, it might conclude that there is single performance obligation to stand ready to process as many transactions as the consumer requires. Okay, so it is considered as single performance obligations. It cannot be separated out. It is, since one performance obligation is there, that is of continuous supply of goods and services, continuous transfer of goods and services. If that is the case, it would be reasonable to conclude that there are multiple distinct time increments of the services. Each day of the access to the service provided to the customer could be considered substantially the same, since the customer is deriving a consistent benefit from the each day access, even if a different number of transactions are processed each day. If the vendor concludes that the nature of the promise is the processing of each transaction, then each transaction process could be considered substantially same, even if there are multiple types of transactions. Very important line. See, very important line. See, every day the supply is being done and every day it is being simultaneously consumed. So therefore, one concept is there that we can consider is that each day separate goods and services are supplied, separate services are supplied. Each day the services that are supplied are distinct. This can be said then. But one more additional point, that contradiction that comes into point, is that each transaction processed are substantially the same. Okay, even there are multiple, each day it is being supplied, can be considered separately, but the items are not distinct. The items are not distinct. These are similar. Okay, could be considered substantially the same, even if there are multiple types of transactions that generate different payments. Okay, different payments, why? Because at the end of the month or periodical payments are there. Okay, so generate different payments. Furthermore, each transaction process could be distinct service, because the customer could benefit from each transaction on its own, or could be used or could be separately identified. Accordingly, it would be reasonable for an entity to conclude that this contract meets the series requirement. Okay, it is one contract, it is one performance obligation, and the performance obligation, the responsibility of the entity is what? Is to deliver a series of goods and services. Is to deliver series of goods and services. One performance obligation, one contract. Okay, are you clear? Are you clear? Despite these are distinct, but these are very much similar. Despite of being multiple, these are quite similar and can be aggregated as one. Okay. Next, last illustration number 13 based on this above example. Okay, and then afterwards from illustration number 14 we will carry on in next lecture. Could the series requirement apply to hotel management services where day-to-day activities vary, involve employee management, procurement and accounting? Okay, this day-to-day services should be separately identified or it should be series requirement. How? See, the guidance requires that each goods and services are to be substantially the same. The provided services and goods and services should be substantially the same. Management should they need to evaluate this requirement based on the nature of its promise to the customer. For example, a promise to provide hotel management service for a specified contract term may meet a series criteria. There are certain activities that can be considered as series criteria, that can fulfill the series criteria, series requirement, whereas there can be times where even though some of the underlying activities may vary each day. The underlying activities, for example, reservation services, property maintenance services, are activities to fulfill the hotel management service rather than the separate promises. The distinct service within the series is each time increment of performing the services. It is said that that it could be series requirement, it cannot be. It depends on the hotel management, how it has done the contract. Okay, if it is planning a contract, if it has done a contract that it will be supplying the repetitive services for too many times, okay, same services, then it should be considered as one performance obligation. If it is promising some other add-on facilities every time with each other customers, okay, separate services are held on, then it should be considered as separate performance obligation, separate contract. Okay, so that's it for this lecture. See you in the next lecture. Till then, take care, be safe, stay tuned. Don't forget to check out the description box. Do download the app and comment me how are you enjoying these lectures. Are these lectures helpful for you? Okay, I'm eagerly waiting for your comments. Chalo, bye bye.